My first job was working as a mathematician, trying to understand how human beings interacted with a telecommunication system, both data and voice, and how that would be managed and what equipment would be used and what the experience would be for an individual working in that system. And later on, some of these same tools were applied in finance, in financial markets. So my first pure job in finance was working as a corporate finance consultant, where I worked with Fortune 100 companies, looking at across their businesses, looking deeper into the business to understand the value, how the value was created that resulted in what their shareholder value would be. From that point, I worked in the reinsurance business, which is a form of providing capital within the financial services sector. So it's a form of asset management. And that led me on to the asset management business. And in the asset management business, I was the head of the client advisory function. It was a global function at the world's largest asset manager. And my responsibility was to provide thought leadership on investment issues, including how to solve various problems, and also to provide advice to our largest clients around the world: sovereign wealth funds, corporate and public pension plans, foundations, and endowments. These are some of the largest and most sophisticated investors around the world.
I don't think I've ever looked for a job. Somehow I sit at my desk and the phone rings and somebody says, "Frank, do you want to do this?" And I say, "Well, I've never done that before." "Well, why don't you try it?" "Well, I don't know anything about it." "We'll try it anyway." So, okay. So by a couple accidents, I ended up on Wall Street working at the New York Stock Exchange. My job was finance. And once again, I had one finance course, so I didn't have any finance education. So what I did was what I usually do, is figure it out. So sequentially, I worked at the New York Stock Exchange, Kidder Peabody, Merrill Lynch, Barclays Bank, and then the last 13 years, I was the Chief Investment Officer and the Executive Vice President at a very large, very good insurance company. I was responsible for up to $30 billion, billion with a B, of stocks, bonds, and real estate. I remained at Guardian until I chose to retire. When you retire, you have two decisions to make: where and what do you do. Where was easy for me. I got my PhD at Stanford and wanted to get back to the Bay Area. What to do was a little more difficult. I hate golf about as much as I do engineering. So by another accident, I was offered a tenured full professorship at San Jose State University teaching finance. And during the last 11 years, I've taught the same two courses every semester, which is portfolio management, and the other one is business valuation and venture capital. Everybody in Silicon Valley cares about venture capital. I knew nothing about venture capital, but Silicon Valley has venture capital in the air, and I breathed the air and I caught it. Most of these students at San Jose State, either undergraduate or masters, they're from families that they're the first one that went to college. They don't have a history of financial or career success, and I've made a material improvement in the lives and the careers of many of those people, and it made me feel really good.
I am a teacher, and so I need to be in touch on the academic side with all the new developments. And as I mentioned, there are a tremendous number of very bright people who are trying to advance our knowledge about this subject. It's the same as advancing our knowledge in science and engineering. And we have people that are just as bright working in finance and investments that are trying to advance our thinking about that. So one side is keeping in touch with best methods in portfolio construction, best methods in optimization, all the things that would apply to improving portfolio efficiency. And at the same time, you need context for that. So you have to be aware of, what's happening around the world. I mean, how do you possibly keep in touch with all the papers that are being written, with all the events that are occurring, it's an incredible challenge. It's really hard to do it yourself. When we think about individual investors, not only what their abilities or talents are in figuring those things out, the most important thing is their level of interest. How much time and interest do they have to really spend keeping in touch with what are the best ways to invest and what's happening all around the world? Many advisors will emphasize that the most important thing is trust. I roll my eyes when I hear that, because that's so obvious and fundamental. Of course, that has to be true as a minimum, but you're going to need a lot more than that. I think what you need is an advisor that knows you, knows your own situation in terms of a whole financial plan, and is able to translate that into a portfolio that's going to work for you.
Often I'll have somebody walk up to me and say, Frank, I want to build my portfolio. Do you like stocks and bonds? And I always say, if you want me to comment on your portfolio, come to my office, take an hour, and the first thing we're going to talk about is not stocks and bonds, it's about you. So if you want to talk to me about your portfolio, you're going to have to talk to me about you first.
Trusted advisor is not good enough. He has to know, why is it in the portfolio? Why is it in the soup? What impact will it have on overall performance in good times and bad? So you have a responsibility, not only for a trusted advisor, but one that you feel comfortable with, who will educate you, who will take the time, who will increase your interest in learning how these portfolios work, how these individual funds might work if you choose to go that route.
When I was in New York, I worked at one company where we sold mutual funds. I wasn't in charge of sales, but I was responsible for the fund management. And somehow a variety of elements of that process I didn't think were best for our clients. What I've often said is, they wouldn't have passed my mother test. My mother test is, I will only do the best of the best for my mother, and what I was involved in New York didn't pass the mother test. Private Ocean, they passed the mother test, and I would put my mother in our funds. That's a very, very high standard, as you can imagine. One thing that most investors couldn't comment on about their portfolio is their expense efficiency and their tax efficiency. When a portfolio manager gets a return of 8%, very often he loses 0.5% on taxes and 0.5% on expenses. The top line is 8%, but really all the customer gets is 7%. We are very, very tax efficient. We are very, very expense efficient. All of the experts have the number one element in the portfolio is a low expense ratio.
You need someone who's going to take the time to explain how an investment fits within your portfolio, why it's there. The fund is there in the soup, your portfolio soup, for a reason. Perhaps to protect you on the downside, perhaps to provide an additional return in good times. It's not sufficient for you to say, there's the smartest guy in the room, I trust him, let's go for it. There's a responsibility on your part for you and for your family to understand how your investments will be impacted in good times and bad.
We are held to a fiduciary responsibility. Fiduciary means that you have no conflict of interest, that you do the absolute best for the client. A lower standard of responsibility, which is what the stockbrokers abide by, is suitability. They have to do something that's good for the client. There's a big difference between those two. Where the difference comes out most vividly is in conflict of interest.
But there's a further duty to say, what new am I learning that I can apply in my portfolio to make it more and more efficient? You can't stand still. There are higher levels of responsibility I think you have to your clients, and that's to proactively continue to learn. This is not just static or an art form. There's a science to it too, in terms of the advancements in academics, in terms of the number of papers written and published. as well as the expertise in how to apply these ideas into real portfolios and the software and the tools that go along with that.
Our portfolios are diversified, not only diversified domestically, but diversified globally. We're diversified in types of securities, we're diversified by credit risk, any type of element there is, we're diversified by active versus passive. So we're strong believers in diversification. The way the experts describe diversification is a free lunch. You can decrease your risk without decreasing your return.
Frank and I are learning all the time. I mean, we have very interesting conversations about what's happening in the markets, what's happening in the literature, sharing papers, new developments. Sometimes we find something saying, there's something here that we could apply in our portfolios to make them more efficient, to control risk, to provide more return. And that's where we've got to read it again. We discuss it, we think it through, and we decide how we're going to apply it to your portfolio.
So I think we have a very, very well-balanced approach between the science of portfolio development and the practice of doing wise things. Fundamentally, we do the absolute best thing for our clients. I would debate anybody about their portfolio against ours, and I would win the debate. I think we're the best of the best. I wouldn't want you to think that we at Private Ocean behave according to this higher fiduciary standard just because it's the law. Everything we do every day is in the best interest of our clients. That's what we do without having to ask a lawyer what fiduciary means.